Hello, everyone. Welcome. I am very happy to be joined by Richard Holden and Stephen Hamilton today to chat about tax. Now, I can see which countries people have come from when they listen to this, so they'll definitely know who these people are, but I will do a brief introduction. Richard Holden is Cietia professor. Is that how I say it?
That'll do.
Yeah, of economics at UNSW Business School, director of the Manos Innovation Lab in Education, and also president of the Academy of Social Sciences in Australia, as well as chief economist of the Chartered Accountants of Australia and New Zealand. I promise to not talk about New Zealand too much today. Stephen has been here before, and he is assistant professor of economics at George Washington University, as well as a visiting fellow at the Tax and Transfer Policy Institute at ANU. They both write substantively in the newspaper, and I have to admit that coming from New Zealand, I was a big fan of both of them, constantly read their material, and so I'll try not to sound too starstruck, but I'm very excited to have them here today. How's it going, Richard and Stephen?
Be better if there was a better election campaign, but otherwise okay.
In my view, it got a lot better
Yeah.
2 days ago, but we'll talk about that later.
Excellent. So
it's tax day. It's tax day here, I should say. Today's tax day.
Have you filed, Steve?
I have not filed. So I have 4 hours from now to file. My wife is a business, so that involves a lot of expense itemization. So I'm going to have a very, very busy 3 hours after this. But anyway, tax day, it's a big deal. It was fun. I taught my students today on tax day. Best day of the year.
Beautiful. So I was thinking we can start off by touching on areas in tax where you guys agree. So the purpose of this discussion is very specific. I want to touch on a couple of areas where you guys have come up with slightly different policy proposals. And the purpose of doing so is to show that, you're both credible, thoughtful, mainstream economists that can reach slightly different views, but it's based on a similar framework. And when people then come out and say something completely wild about tax because they're seeing some disagreement, they're actually subject to that same framework and they should be doing the same thinking. So I want to give the public that sort of example of how people should talk about tax and think through it, even if there's slightly different results, and rule out a lot of the crazy stuff and the people that just say wild things as a result. Now, 2 areas where you guys have agreed a lot have been on a tax switch from income tax to GST and on resource rents. We're not going to touch on those today, but I think those are both fascinating topics for the future. The one I want to chat about a little bit is the discussion on housing subsidies, specifically the idea of deducting mortgage interest from personal income. So this is quite rare. It's done in the Netherlands and Switzerland, but that's because they tax the imputed rent. They tax what you would be paying on rent if you were renting that property. And so it makes sense to have that deduction. The Australian proposal doesn't have the tax part, just the deduction. And I saw this morning Josh Hawley in the US is pitching exactly the same thing. I don't know if he's picked it up from here or not. So I'd be pretty keen to hear both of your views on how you'd think about this and why you might think it's bad policy. And let's start with this one with Richard.
Yeah, look, I think the mortgage interest tax deduction idea in Australia is a bad idea. And as you pointed out, Matt, there are ways to try and make it more neutral by worrying about imputed rents and kind of doing all that kind of stuff. I don't have a lot of confidence in our ability to get those kind of patches right. So I start with the viewpoint that we shouldn't be subsidizing private consumption, and that's largely what we'd be doing here. And so I think it's a bad idea. We already provide all kinds of different subsidies for housing in Australia, and I'm sure we'll come to that. But in terms of exempting it from the primary residence, from asset tests for pensions and other forms of government assistance, in terms of exempting it from capital gains and so on, I think the last thing we want to be doing is pouring more fuel on the demand side fire. And even the way that the alternative government have proposed it is sort of trying to find a certain group of people you want to give it to. Like, To be honest, I'd rather they just took like a big bunch of money and went and over to those people's houses in the middle of the night and gave it to them. That would be less inefficient than trying to do it in this clumsy way.
I don't know, that makes sense. Stephen, how would you sort of think about the issue as well?
Yeah, I fully agree with all of that. Totally agree. 100% on board. I would emphasize two more things. One, integrating a housing subsidy into, so we could talk about this in a principled way, let's have capital gains tax, let's have the, imputed rent tax, and let's allow the deduction. Okay, I get that. That's not really what this is. What this is just to try and subsidize housing. Like the point of taxing it in that way is to neutralize it so that the tax has no effect. This is designed to have a positive effect. So, as Richard just said, it'd be better to just give them the money. You could just do a first home buyer grant, which we've done forever, and lots of states still do this. But what they wanted to do is deliver that through the income tax system. And that's really what I don't like, because what you're doing is you're sort of mutilating your income tax system to achieve this housing objective. And I heard a quote by Peter Costello, back in the day. He opposed the mortgage interest deduction for exactly this reason. Don't provide your housing subsidy through the income tax system. Just provide them a housing subsidy. And why is that a problem? Well, it narrows the income tax base. And we tend to be wanting to avoid deductions, right? We're trying to broaden the base, right, and lower the rate. And you might think it doesn't matter so much because it's only 30,000 people, 50,000 people, right? Because it's first home buyers and they have to have a new house and they have to meet the income criteria, right? But, and this is the other big problem. My guess is it would never just stay at 30 or 50,000 people. You have this subsidy in place. And then what you have to tell people is after 5 years, your mortgage interest is going to double.
Yeah,
it's going to go up by 100%.
Try taking it off these people at that point, right? And then they say, yeah. but I'm like massively over leveraged and over committed, and I'll have to,
exactly.
It's just not credible.
Yeah. So you've got to increase their interest rate. You've got to double their after-tax interest rate after 5 years, and so you can imagine that what would happen is they extend it. And then there's this issue about, what about people? You bought a house last week, you don't get it. You bought a house this week, you do get it. And you could feel it gets extended to existing buyers. And then it gets, we don't want a new, what about existing houses? And then it gets extended to existing houses. And then we end up in some alternate universe in 20 years' time where every Australian's mortgage interest is deductible. And that's we got to shut this thing down right now. We got to not open that little crack, because I can just see a truck being driven through it over time. So, and that's what I mean by undermines the integrity of the tax base. I really do think that it will blow up. The second thing to say, and this has been under realized, is there's an income limit, and it's a hard limit. It's what a public finance person would call a notch. If you earn $1 above, if a couple earns $1 above 250,000. You're completely ineligible. And this is ineligible for a $55,000 subsidy over 5 years. Like, you can imagine the potential for gaming. I reduce my income this year so that I can qualify. And I'm told that this is a set and forget thing. You have to qualify once and once only, and you get it for the whole 5 years. So you can imagine people's income dropping for eligibility and then blowing up afterwards. It's just a nightmare. And I hate it. I cannot tell you how much I hate it.
Yeah, I mean, so if there were three things I had to take from how you guys have just described it, and you've described it very well, one would be, look, we can think about the tax system as functioning on income, and this is ultimately, there's a principle of if you tax the income, you allow the expense. But in this case, there's no tax on the income and there's the allowance of an expense in some sort of arbitrary way. So it sort of breaks those principles. Secondly, it's once we start breaking those principles because we actually have an expenditure goal, it's quite a non-transparent way to do it. It leads to further erosion of the tax base. So if we want to do it, just do it through spending, make it transparent, make it clear, and leave the tax system as more a set and forget thing. And then finally, this specific design has a lot of flaws probably needs some people to look at it. Notches like that are just madness. And, people with a bit of economics training would be able to spot them with
And you
huge red
notice
flag.
neither of us talked about pushing up house prices. Neither of us talked about the cost of the budget, right? We take that as granted.
Yeah.
Obviously stupid on that basis, right? But when you get into the detail, it's even worse, I think.
So that was really useful and like a great way to get your guys' thoughts on initial frameworks, a good warm up. Now I want to dive to a topic where there might be some disagreement. So negative gearing. I think this is going to be a lot of the discussion. So just to warm up the audience, I want to provide a little framework, which I think is fairly neutral and allows all sorts of arguments to come from it. So the framework I'll have is when you own a rental property, the government intends to tax the income you earn from that property. This reflects rent and capital gains, minus the expenses, so rates and maintenance. So you have a revenue, which is rent and capital gains, and you have expenses, which is rates and maintenance. Negative gearing is a situation where you actually make a loss on that property, so expenses exceed revenue. But because we have a comprehensive income tax, you can claim that loss against other income and thereby lower your taxable income and lower the tax that you'll pay. And in that case, you are making a genuine loss and it's being claimed against it, and that's sensible in a sense. But other countries do have hypothecated systems where they try to tag the specific income to the asset that's generating it. Now, the key debate that's going on in Australia, which is quite wide-ranging, is about whether these expenses should be deducted, and if they are, when they should be deducted. So is there going to be a disallowance or a deferral? And how can we conceptualize that? So very keen to hear from Richard first, given his proposal. Although, no, hear from Stephen first because he has his hand up, which people can't see online.
I just want to say one thing, which is you can negatively get in other assets.
Yeah.
Obviously, when we think about it, we think about houses, but you could do it with stocks. Obviously it's easier to get a loan for a house, but in principle, it's anything. And then the second thing I just want to add quickly is you described negative gearing correctly, but I think people see negative gearing as like the word for housing tax concessions.
Yeah.
And I don't actually, it's like negative gearing bad. It's like where I think if you ask people define what negative gearing is, I think almost nobody could do it. So we're going to be very precise here and talk about the specific items, but it's probably at some point worth talking about just the broader principle of housing tax concessions.
That's a fair point, and definitely feel free to, insofar as negative gearing relates to other tax instruments, and you think that there's an overall systems view that brings that together, definitely feel free to bring it in. This is your guys' debate to sort of lead your arguments on. So with that, I'll pass over to Richard to put down his proposal about negative gearing, and then jump to Stephen to reply, and then let you guys have a discussion about it.
Thanks, Matt. Look, I have a proposal of sorts. I wrote a report for the McKell Institute in the middle of 2015, so it's a while ago now, that considered 5 different options about negative gearing. I had a favourite option among those, and that favourite option happened to be picked up by the Labor Party and taken to 2 federal elections, both of which they lost. Maybe because of that, maybe not because of that, but full disclosure about the context of it. But my preferred option was to phase out negative gearing, so not get rid of it immediately, but to phase it out over a period of time. And I come at this from a context of fully understanding what Steve just said, that one, this has been around for a really, really long time, like well over 100 years as part of the Australian tax code, and applies to all other asset classes. But I want a level playing field in 2 main dimensions. I want a level playing field between different asset classes. And I don't want to get really interventionist about stocks versus bonds or things where there might be market frictions or market failures, because, you could just get caught up in the details of that, and there are minor things. then you might end up being too interventionist, and I don't like changing tax rules on a sort of high frequency as a result of that. But property is a radically different asset class. So there is no other asset class where people can borrow 10 to 1 to get into that asset class, where banks are allowed to treat this in a much, much lower risk category when determining the amount of capital that they need to hold and things like that. And that's exactly why it is the preferred asset vehicle for so many people to make leveraged investments in Australia. And so, people can't borrow stocks on, regular folks can't borrow stocks on margin or bonds on margin or leverage themselves into hedge funds the way they can into housing, not just by a little bit, but just like not even in the same ballpark of being able to do that. So you get exactly what you'd expect, which is this is how people speculate on asset prices. So I think there is a sufficient imbalance between the treatment of housing deductibility and other deductibility of investments that I think we should rejigger that playing field, make it more level. And I think getting rid of negative gearing is one way to do it. And we can talk about whether you should, fiddle with the capital gains tax discount or some combination of those things. I don't want to fetishize one versus the other, but I basically think the tax treatment of residential property investments, particularly in a regime where the top marginal income tax rate kicks in at a very low level, a very low income rate, and is 47%, creates all kinds of distortions. The second area where I want to level the playing field is between owner-occupiers, potential owner-occupiers and investors. And I think housing is a special market in one way, which is it's a really important part of providing people with human dignity and also a stake in their community and the society, being an equity holder in that in almost a literal sense. And I don't think it's a bad thing to rent, or that everyone should own a house from the time that they turn 18 or anything like that. But I think there is something to the George W. Bush notion of an ownership society, and that when we put property investors and potential owner occupiers on a radically unlevel playing field when competing for properties, that creates externalities that I think are undesirable and should be addressed. So I get the backdrop. I understand that. I understand tax purists hate the kinds of things that I'm proposing, and I don't take them lightly, and I'm not an overly interventionist person when it comes to these things. But I think there's something very peculiar about this market, even more so in Australia, that means we should treat it differently from a tax perspective.
Cool. Over to you, Stephen.
So what was the concrete proposal? I didn't know about it. What was the concrete proposal in the first part?
So what I proposed, I think it was option 4 in the McKell plan, and I think this is a component of what Labor took to the 2016 and 2019 elections, was that existing people who've got existing negatively geared properties would be able to pay down their loans and enjoy the negative gearing, but they couldn't re-lever. Okay, that new purchases of existing homes for investment purposes would not attract the negative gearing discount, but that but purchases of new properties in a bid to try and encourage supply in a kind of political economy way would have access to negative gearing. Now, again, you could tweak that at the margins, but that was the proposal.
So when you say access to negative gearing, do you mean you have to carry forward the loss?
No, I mean it's
so
not
like in a given year, I have like a rental loss of $20,000. Are you saying I carry forward that loss, or are you just saying that
what I'm saying is you can positively gear, right? But you can't offset it against labor income or other income.
Yeah, but can you roll it forward and then offset it against the future capital gain?
Sure.
Yeah, because so it's not so that is actually pure. If that's the proposal, which is you're not denying people their rental losses, you're just saying you can't claim them against labor income. So what will happen is they'll just roll them forward, roll them forward, roll them forward. Then they go to sell the house, they get a capital gain, and then they get taxed on the difference, right, between the loss carry forwards and the capital gain. That is like that's purely about negative gearing, nothing to do with anything else. That's just like whether you can offset the loss against other income. So that's
which as we both know, like that rate is quite a lot higher for a lot of people, that ordinary income tax rate. And I know you've written about this, but there's a big difference between 47 and 23.5 or 23.75.
It's completely crazy. Yeah. No, I agree. I mean, I think most people, when they're anti-negative gearing, you're sort of not anti-negative gearing. I mean, it's sort of the problem with any kind of asset is you have costs each year, and then the revenue comes later. So there's a mismatch in timing between the cost and revenue. So you're gonna get tax losses, and then you're gonna have a tax gain. And really, we should be taxing the aggregate, which is why we allow loss carry forwards, right? We should be taxing the investment in toto. I think a lot of people, when they have negative gearing in their crosshairs, it's usually more punitive than that, I think, is what my understanding is of that.
And there were a number of other just to put it in context, and this is why I consider 5 different things. The Grattan Institute at the time said we should ban it all immediately, and as I understand it, include positive gearing. So it was like, turn the lights off right now.
Yeah, I'm not sure.
And I thought that would create enormous financial dislocation, among other things. There are other people who said things about the capital gains tax discount and so on. So there are these ideas can come in many different shades and colors.
So I think that's actually quite reasonable. I wouldn't do it, but I don't think, if someone had said that, I don't think it's nuts. You know what I mean? I think it's arguable, and ultimately you're just saying you're going to get the loss. You just can't get it now. You've got to get it later. And that's I don't think that will have a huge negative impact on investment. But I think so for me, you pointed to it there. Like, in my view, the bad part about, and I don't really have a comment about the asset classes. I don't know how to think about that, but I haven't thought about it that deeply. But immediately not so sure. But let's just put that aside for a second. I mean, for me, the issue with negative gearing is something you just said, which is, you get to deduct the interest at 47 cents against your labor income, and then when you go to sell it, you get taxed on a 50% capital gains discount, so 23.5% or whatever. And obviously that's a distortion. I mean, there's no way, there's no way that's a neutral tax treatment of an investment, is to tax people at half the rate that their expenses are, to deduct the expenses at twice the rate that the benefit is taxed at. So, limiting that in some way brings, to the extent the existing system is a distortion that incentivizes investment. Your thing is pulling it back, because it means they have to offset. They have to offset that loss in the year that the gain is made, right? So my proposals that I've made at various times, but I wrote it in the newspaper on the weekend, but the dual income tax, which is the system that exists in Northern Europe, and I think, in principle in some other places, what it would do is it would more directly address that issue of mismatching rates by just hiving off the entire capital income source into its own bucket. So you would basically have in this year, I have a net rental loss. I deducted it, let's say 20%. I don't know, pick a number. We can argue. Maybe it's 15, maybe it's 25, whatever. Maybe someone like Grattan would say it should be 30. I don't know. But we have a number, and you can deduct you get a tax loss based on the 20% rate on that rental loss, and then so you're owed money. You get a dollar number, right, which is the tax rate multiplied by the loss, and then you can offset that number in dollars like a tax credit against your income tax liability. So you're neutralizing the rate issue, right? Because you're only offsetting the tax liability. You're not offsetting against the marginal rate. And then when you come to sell the house, your capital gain is also taxed at that same 20%. So I don't think like we'd have to run a model or something to estimate the differential impact on, investment and prices and everything of the two proposals. But I don't actually think they're that far apart. I think they both recognize that the current system is distortionary, clearly, and there are a number of ways you can try and claw it back. I just sort of, I'm not sure a lot of people were thinking about the dual income tax for Australia in 2015. It's only something that we've sort of been thinking more about lately, and certainly like the Henry Review, for example, didn't propose a dual income tax. So yeah, so I don't necessarily think it's incompatible. I guess what I'm arguing for is the issue that I am identifying, I think I'd like to solve that at its source, and then I think the negative gearing problem doesn't really become so much of an issue.
Yeah, and I think that's a good example of how having a framework in mind helps discipline these kind of discussions, because I have no particular problem with the dual income tax idea. As you say, that wasn't sort of in the zeitgeist 10 years ago in Australia, so it didn't naturally come up as a proposal. But if someone had said, well, couldn't you skin the cat this way? I would have been like, well, that's fair enough, But if you have a framework in mind, then you can address these things, and we can have a more reasoned discussion about what do we exactly mean by level playing field and so on. But then it's just an implementation question. And I don't particularly, I'm not wedded to, is it done through a dual income tax? Is it done through getting rid of the CGT discount rather than the negative gearing thing? Usually those things come down to actually kind of psychological questions about how investors are going to behave, that I'm not the world's best equipped person to advise on, but at least it disciplines the discussion quite a bit.
Yeah, I think the key, you want the deductions, and my view is you want the deductions and revenues to receive the same tax rate. I feel like that's I feel like that's quite a modest proposal. Why are we taxing bank interest at 47 cents in the dollar? Like, that's insane, right? Why are we doing that, right? So, that dual income tax sort of is a broad kind of wipes all that stuff away.
Just as a clarification on that, so if the CGT discount disappeared, would everyone just sort of leave negative gearing alone and wander off and focus on other things?
Well, I think it would depend. I think it would depend what you applied it to. So, let me also be clear: the Labor Party, when they built on my report, they also proposed changing the CGT discount, and they understood, because they're thoughtful people, that there would be implications for different asset classes and so on. So once you start fiddling with the CGT discount, you quickly get into a whole other territory, which is, should we have the 50% CGT discount on all capital gains, like when you sell shares of stock or interest in a private company or a stamp collection or whatever it might be, right? And that, as I always see it, is really about thinking about not wanting to double tax people. You've got to earn money and pay tax on it before you can invest. And if you then charge people the same CGT rate as you do the ordinary income tax rate, you're going to encourage them to consume more and invest less. And we generally think that that's less good for economic growth to not have as much investment. Now, what the number should be is a whole different question that depends on elasticities and fancy things like that. So should the discount be 50%? Should it be 25%? I think there's a reasonable discussion to be had about that. But all I would say is, once we get into the capital gains tax discussion about property, it's hard not to also get into that discussion about every other asset class, in part because they're so interconnected. And so we should be very mindful of that in thinking about how that debate or discussion goes.
So I believe a lot of this is driven by differences in the ETRs between asset classes, right? And those ETR profiles you often see generated come from a difference in the view about the relative capital gain versus flow income associated with the asset class. And a lot of the time, housing is being driven by that as well as superannuation. Um, is it about those relative ETRs that's driving a lot of this, or is it the level of capital taxation is just too high? As Stephen noted, the idea of a 20% rate that's equal across the board, is a lot of the benefit there coming from a lower rate stimulating investment or the relative ETRs? I think that's just helps us frame this negative gearing stuff
Yeah,
a
I
bit
think
more.
it's both. I mean, I think on one hand, you're the differential tax treatment across asset classes has to be distorting those margins to some degree. I mean, we have to ask ourselves why, if you work for a super fund, cash returns taxed at 15% and your capital gains taxed at 10%. But if you have a stock portfolio, like we have a totally different tax regime. And like, why? Like, like they're doing the same thing. They have the same, like, there's no reason why they should get it. I can't think of a good reason why you should tax them differently, but we do, right? Again, why are we taxing interest at 47%? You know, you own a bond and you get taxed on the return at 47%. I mean, that's insane, right? You know, Granny's bank interest is getting taxed at 47%. I mean, if they have really high income grannies, you know, whatever. But I find this to be, I find this to be bizarre. And the other thing is, why do we have a progressive rate of capital taxation? Doesn't make any sense. No good argument for that. Why do we have a tax-free threshold for capital income? Bizarre. Why do we do that? I think the whole idea is, we wanted a comprehensive income tax base. So we lumped capital and labor in together, but I don't think they go well together. My view would be, hive off all the capital items, put them in their own bucket, hit them with a flat rate that's low, get rid of all the distortions across asset classes. And then my view would be, and I don't know if Richard agrees, but I suspect he might, I actually want to lower the rate on capital, not raise it. and that's where I differ from, a lot of mainstream economists in Australia and, people like Grattan and whatever else.
Well, I agree with everything Steve said about that redesign. I'm on record as saying, and I'm happy to repeat it here, that, and I stole this line from Larry Summers, so I won't make him defend it, but I'll, give proper attribution, that I would like the rate of capital income taxation to be closer to the ordinary income rate than to zero. That's Larry's quote. Having said that, I don't think the rate on ordinary income taxation in Australia should be 47%. Certainly not where it kicks in. So if you told me that, Steve, the answer is 20 or 25 flat rate on income taxation, I could totally live with a number like that. But I think this just all goes to the, I mean, people have obviously talk about comprehensive tax reform and so on, but these things are so interconnected that the idea of fiddling with one thing here or one thing there,
that's right,
is just so peculiar.
That's partly how you
talk
talk
about it for 2 seconds. It's like these things are all so connected that it makes no sense.
Yeah,
Exactly.
So I guess I would just say that, I think comprehensive reform is good. And I think, honestly, I mean, I like low rates of capital taxation. The biggest problem with higher rates, low rates is people reallocate the labor income as capital income, right, as a means of avoidance. But, whether it's 20 or 25, I mean, I whatever. I think what will actually happen if the political system decides to get a hold of this thing, because I think at some point the political pressure on all these tax concessions is going to build to the point where some government has to do something. It's a bit like this housing rubbish in this election campaign. They all feel like they've been pressured so hard to do something, so they come up with these cockamamie ideas, right? So I think the issue with these tax concessions and other things will grow. and we'll get to a point where we'll have to do something. Hopefully that they do something rational, not something that they come up with in 5 minutes during an election campaign. But if they did, my guess is it would be driven entirely by the revenue constraint. And it's easy for Treasury to calculate that, right? Here's how much revenue we want to collect. We're going to make all the rates neutral, even maybe superannuation, just everything gets the same rate. What's the rate? And maybe it would be 20, 25%, maybe it'd be 30%. If a Labor government says we need to raise more money, maybe they put it at 30, so I think it's probably going to be more driven by that than anything else.
That's all really good. And I'm going to make a quick shout out to the New Zealand microdata people that'll be listening. So New Zealand had ring fencing of losses for the same concern many years ago. They introduced full rate taxation of the capital gains on housing through the Bright Line out for 10 years of holding the asset. And then they fully disallowed first depreciation and then all expenses. And then they've reversed that. There's rich housing microdata linked into the integrated data infrastructure. So could you guys do some work there and send it over to us? We'll appreciate it. Now, in the standard deduction space, I was keen to have a bit of chat about what's sort of going on with that. Now, as a New Zealander, this is something I know nothing about because there's no deduction there and also no tax-free threshold. And I think something Stephen just said in terms of why do we have a tax-free threshold for capital income is a really nice segue into this. The tax-free threshold and standard deduction serve some types of similar purposes, and it'll be useful to, when discussing them, sort of try to talk about both a little bit as well. So what's the framework here? When you operate a business, such as the rental property, we talked about you deducting expenses that are used to generate that revenue, such that you only tax the income. And that stops situations where if the tax rate is less than 100%, you don't switch the amount a person receives from positive to negative. We can extend this logic to labor income, though. So when you go and you drive to work, or you get a train, or you buy a coffee at the cafe in order to be awake enough for work, these are necessary expenses to do your job, and hence in the same way they should be deducted from income. We currently allow itemized deductions in Australia, which is where individuals can report these expenses over a financial year, provide evidence, and receive a deduction. So it's taken out of their taxable income, and their taxable income will be the amount of labor income they earn minus this. Now, a standard deduction would allow people to claim these expenses without the cost of itemizing and doing all this at the end of the year. They can just claim the fixed deduction when they opt in. Now, Stephen has proposed this when he was at Blueprint. I'll put a copy of the report down below as well. Stephen, would you be able to talk us through the argument for this deduction?
Yeah, that was a good summary. So in the US, they have no tax-free threshold, but they have a really big standard deduction of like 25,000. And one of the reasons why the standard deduction is so high, partly it's because, as you said, it's sort of, if you don't have any deductions, it's identical to a tax-free threshold, right? Partly it's because they wanted to phase out the mortgage interest deduction, which is, I enjoyed reminding the readers of the Financial Review that Trump got rid of this idea, right? So they've made the standard deduction so high that it's above most people's mortgage payments, right? So I think it's only 5% of Americans itemize. It's a very small amount now. So the other one is state and local tax deduction that they have here. So anyway, yeah. So it's very similar to a tax-free threshold, but it has a much more. That's a sort of byproduct. That's not its purpose. Its purpose is it's essentially a trade-off. So as you pointed out, the sort of first best is to allow deductibility of legitimate expenses. Your income tax rate will become less distortive to the extent that you allow more legitimate expenses. Now, that you can easily write that down, but it's also just Atkins and Stiglitz, right? I mean, Atkins and Stiglitz, which I invoke almost constantly, is providing a tax benefit to things that are complementary to work, right? That is a justified use of indirect taxation, right? Which this effectively is. So that's a kind of wonkish answer to why deductions are good, but in principle they're good. Now the problem is, this is a good example where we don't want a first best solution. Actually, the second best solution is better, and that's because it's not the case that you can just expense things and it's costless. Deducting things involves very significant expenses, both at the individual level and on the tax administrator side. And if you talk to anybody at the ATO, anyone who's worked there, I've talked to commissioners, whatever, they consistently say one of the hardest parts of the ATO's job is policing these work-related expenses, because they are so easily, fraudulent, right? Because, you've got to have a receipt, but, they're not going to audit everybody. There's no third-party reporting of these expenses. And so much of their kind of compliance work goes into policing these things. So that's kind of so in other words, if you take these away, you lose the welfare benefits of the sort of first best, you should deduct these expenses, but you gain the welfare benefits of lower compliance costs and lower administrative costs, right? So you get to sort of trade off. Now, let's talk about two things. One, my job market paper, I sort of showed that almost all of the behavioral response to taxes in Australia is deductions. So the elasticity of deductions is about 10 times larger than the elasticity of gross income. So when you think, oh, taxes are bad because they discourage people from working, actually, taxes are bad because they encourage people to claim too many deductions. So, that's a kind of totally different way of, I think, the way a lot of people conceptualize it. But, it's a very high elasticity item, and that is clearly because of, again, this tax avoidance, tax evasion kind of margin. Okay, I'll mention one more thing, which is Yusuf Benzati at UC Santa Barbara. His job market paper showed that the US has a standard deduction. If you look just above the standard deduction amount, you see a missing mass. If the standard deduction is like 10,000, no one is claiming 10,001, right? Because they just say, don't worry, I won't bother. I'll just claim the standard deduction because it's much easier. And as you get further away, more and more people, the mass starts to rise, right? So fewer and fewer people are claiming the standard deduction, even above this standard deduction level. So you can use that missing mass to infer people's willingness, sort of a willingness to pay, kind of revealed preference measure of how much people value itemizing versus claiming the standard deduction. If people are literally giving up legitimate deductions to which they're entitled, because it's much easier to do itemizing. So he estimated individual average compliance cost savings of hundreds of dollars per year, hundreds of dollars. It's pretty big. And if you extrapolate that to the number of people we would capture with a standard deduction, you get compliance cost savings of many billions of dollars. And obviously the untold savings in ATO's resource costs, right, in that they would no longer have to police these things. And you put those together and you end up with a kind of a welfare calculation that can tell you what the optimal standard deduction amount is. And we estimated it to be probably about $3,000. And I think in the past, governments have considered proposals of $2,000, and the one that they announced is $1,000. So $1,000 would cover about half of people. That is, half of people have deductions of less than $1,000. Now, so that's the kind of economics of it, right? I think that's pretty clear. I want to say one more thing, which is there's also a bigger picture here, and that's kind of the reason I'm really keen to, pursue this policy, which is that it opens up the door to a radically simplified tax system. So, the ATO has done amazing work over time to expand MyTax, which is our electronic filing system, and pre-filling. They pre-fill lots of stuff. They pre-fill your bank interest. They pre-fill all of your sort of Centrelink stuff. The pre-filling has become kind of amazing, and MyTax is amazing. And I want to say that sitting in America on tax day, I think it's pretty amazing. And when the Trump administration wants to shut down direct file, which is something that we finally implemented last year. And it is absolutely tragic. But anyway, my tax is amazing, and they've done an amazing job to expand it, and they've done an amazing job on pre-filling. The last remaining thing is deductions. The last remaining reason why people need to spend time doing tax returns, and more importantly, pay tax preparers, a bunch of money when they have pretty similar tax returns, is deductions. If we took the deductions out, you really could, if you made that standard deduction high enough, two or 3,000, more or less, you could take away tax returns for 95% of people. And we could then get to a crazy system. You start to think about possibilities. Can we do much better on withholding, and do real-time withholding, so that you can figure out people's tax liability, knowing all the information you have at any time, and your business can update the withholding amount in real time, so that at the end of the year, there's no tax liability and there's no tax refund. We just don't even think about it, right? You've paid the right tax all the way through. You can start to think of these kind of futuristic possibilities of improving tax systems that without those deductions being taken out, you can't really deal with. Now, I want to say one more thing. Sorry, I know I already said one more thing, which is the big problem is charitable giving. That's what everyone's going to say. Charitable giving, you can deal with. You can build a back end, so that any charitable donation, as long as you make it electronically, there's on the back end, you can, the ATO can basically pre-fill your charitable giving, right? So you can imagine you could build a system where the charities didn't lose out from this, where it all gets pre-filled and included. So yeah, anyway, that's the proposal. Now the government's done 1,000. It's a good start. Made my day on Sunday. And the hope would be over time they expand it and maybe index it, and then that would be great.
So Richard, keen for your views on standard deduction as well.
Yeah, so it's hard to disagree with most of what Steve said. I and certainly on first principles, I don't have any disagreements whatsoever at all. I come at it from just a very, very practical aspect, and the reason that I gave commentary on Sunday when the government came out and I didn't feel like they made my day, I felt disappointed with them, and I gave comments that got written up as maybe amplifying that disappointment to a certain degree, was that it just struck me as another piece of idiotic timidity from this government, which is, so Steve has the view is $1,000 is a good start, it's going in the right direction, we'll expand from there. That'd be great if that's what happens. I'm more of the view that you only get so many chances to do these things, and a government that has said, oh, we're going to raise more money from the massively broken, idiotically implemented, thanks to the people in the Prime Minister's office in the early 1980s, by the way, petroleum resource rent tax. We're going to fix that, but it doesn't raise any more money, really. Oh, we're going to, get rid of a whole lot of bad tariffs and stuff like that, but it's actually on like $500 worth of bad tariffs and stuff like that. They just habitually talk up reform and do very little. And I just had the feeling that this was, better than all those other ham-fisted attempts that they've made. But was like, really? Just do $5,000. Just make it $5,000. And if it has to get worked out from there, maybe the number's 3 or whatever it is, but just don't be timid again. And they also decided to paint this as, oh, we're going back and finally implementing the good ideas of the Henry Tax Review. And I was like, good Lord. Firstly, you guys are in the same party that decided not to implement any of the ideas of the Henry Tax Review. So where do you get off saying that? And secondly, really? You're going to pick off the menu and be like, we like this one done in a really tiny little way, rather than saying we've got a real tax reform issue. So I guess I was offended more by the implementation than the impact and the intent. But I don't think those things are quite as distinct as we sometimes think, because this isn't, I mean, I'd love it if Steve was like in charge of tax policy in Australia and he just got given something and it was like, take it from here, Steve. And, he'd work it all through. That's not how
I
it
can do that.
works.
That can be arranged.
Yeah, I mean, I think, there's this thing called the Constitution and all that kind of stuff. But like in an ideal world, that would be very good. But that's not what happens, which is somebody stands up with a megaphone at an election and says, I'm a reforming treasurer, and here you go. And then we wait another, decade for something else to happen again. And I'm just sick of waiting around. So that was my grumpiness was in about execution, not about principle.
I like that I'm the good cop when it comes to the government. That's rare. I haven't called anyone idiotic. I mean, Jesus.
Well, yeah, I think you've said you've said a variety of things, but anyway.
Yeah, well, I usually write them in the newspaper. Anyway, so let me just make a comment. Is that all right?
Yeah.
So it's funny because in Wayne Swan actually proposed this policy already, and it was happening. It was announced in a budget, and then they decided to cut it because they wanted to get back to surplus. I mean, that is extraordinary, right? That happened. This is what they decided to cut.
And can we just go back to the videotape? Let me get it right. And they didn't really get a surplus, right?
No. But this was, in the 2012-ish region. So this was 13 years ago. They almost did it and didn't do it. So, I have to say, I on Sunday, I didn't expect anything. And I've been obviously very disappointed with the lack of progress. So I guess it was like a glass of ice water in hell, like I gulped that glass down. And I would also note that I am very strongly in favor of cutting the marginal tax rate from 19 down to 14 for the 18 to 45 region, because I think that's mostly part-time workers. Well, it's all part-time workers because it's below the full-time minimum wage. So I kind of think a cut to the MTR of 5 percentage points on the highest elasticity workers in Australia with the standard deduction, it's not wholesale reform, but I'd call it certainly better than anything that's been done in a little while. And my hope, and maybe I'm naive, maybe I'm being silly, but my hope is that is a kind of, the best case scenario is that is a sort of signal that yes, okay, actually incentives matter, and we're going to design reforms in a way that, we could have just given people $1,000. We could increase the tax-free threshold. We could have done the Lamido stupid thing, but actually we've done some things that improve economic incentives, and so I can't ping them because I think that's kind of exactly what we want.
If we had an additional hour, I'd like to dig into that sort of stuff more, because the effective marginal tax rates for that group are incredibly high, and estimated elasticities, especially for sole parents, are relatively high. But we also do have, relative to when those elasticities were estimated, part-time employment has shot up, and that's going to be the part-time employment range. So I think it's something worth more thinking. I want to finish off with like hot take on it though. If we're going to introduce a standard deduction, say we did 5K, should we halve the tax-free threshold while we do it? I mean, that would pay for itself, right?
I wouldn't do 5K. And the reason, I'll just make one economic note. The trade-off when you're thinking about the level of standard deduction is the benefit is that you draw in more people, which is good, right? But the problem is the number of people are declining, right? The distribution is going like this, right? And so the people can't hear me making hand gestures. My hand gestures are going downhill, right? The distribution thins out, right? So to keep increasing the standard deduction becomes increasingly expensive, right? Because you are raising the deduction for all the people who already have it to bring in an increasingly small number of new people. And so at some point you just figure it's no longer worth it. Let those 5% of people itemize, whatever, and so that's how you end up with the kind of 3K number, is there's a sort of, revenue balancing thing. So but 3K is 3 times what they proposed. So it's a big difference, right? I like I like the tax-free threshold personally. I think the tax-free threshold generates a lot of progressivity in the tax space. And in particular, if you were able to split labor and capital income apart and prevent capital income from going towards the tax-free threshold, I kind of like the tax-free threshold, but I'm open-minded to be told I'm wrong.
Would a 3K standard deduction with a $3,000 reduction in the tax-free threshold essentially just be doing that though? It would be making the labor income threshold the same as it is now while bringing down the capital tax-free threshold.
I think the problem with it is the biggest problem is you end up with losers. And so if you want to be able to say no one's worse off, you got to just give it to them. And I think the issue is it is a slightly politically tricky policy because, okay, I'll tell you 2 reasons it's tricky, other than the charitable giving one. One is you're giving people who are claiming more deductions today less of an improvement. And I know that this is where our politics is. That it's not just that everybody has to be better off, but nobody's allowed to get more than anybody else. So that's your one problem, right? And the second problem is, there's this claim that people love claiming deductions. Like they get some utility from just claiming deductions. So how dare you take that away from them? I don't know. But yeah, if you don't want anyone to be worse off, you just got to give it to them.
Richard and Stephen, do you have any final points before we wrap ourselves up here?
I think the last thing I'd say is I think the 2 big things on tax, and maybe you can take this as a suggestion for another discussion another time, is Paul Keating, I think, is right, as is Bill Kelty, that the top marginal tax rate in Australia shouldn't have a 4 in front of it. It should have a 3 in front of it, and it sure as hell shouldn't kick in at less than 2 times average full-time weekly earnings. And the other thing is that our company tax rate in Australia has gone from being roughly the second lowest in the OECD to roughly the second highest. And whether we like that or not, that's going to have to go down over time, maybe quite quickly, depending on what happens in the Trump 2.0 world. And we better start planning for how we're going to do that and what it means about rent taxes and investment incentives and all kinds of other things. But I think there are big things coming for the Australian tax system that we better get out ahead of. And I don't see either party trying to do that. And I hope there's more discussion about those things.
Definitely.
Yeah, I would say I think I disagree with and I think we've talked about this before, with the top rate. I'm quite comfortable with that. In the US, if you take the Californian state tax rate and the federal tax rate, you get something that's a little higher than our top tax rate. But as you pointed out, Richard, we don't have state income taxes, so obviously, it got to compare apples with apples. But as you note, it certainly doesn't cut in California at 190,000 Australian dollars. Like I'm in the top bracket. Like, what the hell? This doesn't make sense. You could be in the top bracket, Richard, but I definitely should not be in the top bracket. So, I would say,
I think if hardworking academics wind up in the top bracket anywhere, there's kind of questions to be asked. But anyway.
So I would say if you raise that top threshold I'd love to raise it from 190 to 400, whatever, something radical, right? Because I think the suggestion that, someone earning 100.
No, and we forget sometimes that when you do that, you are lowering the marginal tax rate for a whole lot of people, thereby creating dramatically better incentives.
Yes.
So, I'm being kind of aspirational about, it should be 39 and it should kick in at 600 grand or something. But those things are substitutes. You can do a combination.
Yeah, and they're close enough. The general direction is the same, which is, again, 47% rate at 190K is completely bananas. I don't even understand how this is acceptable and how people are willing to do this. I mean, it's crazy. You have to imagine the level of avoidance, particularly among small businesses, has to be just massive, So yeah. And what was the other thing? Oh, corporate tax. Totally agree. I can't believe we have a 30% tax rate. And the insane conversations we have about like, oh, but the effective rate is lower because of imputation. It's like the bit that matters is the bit that foreign investors
if I had one wish for public discussion in this country, it would be that people were not allowed to use the word imputation ever again. It's such a furphy, and anyone who says it doesn't understand, who the marginal investor is. I wish it was just banned from the public discourse.
Yes. So we need some radical reform of the corporate tax, and that's definitely a conversation for another day, but I totally agree. We can't survive in a world of competitive capital with a 30% rate.
Nice.
So Matt, there was really no disagreement in the end.
No, well, the thing is that's what was good to highlight, right? Is that, in the end, the disagreement, when you start fleshing out the margins, it might be placing slightly different emphasis on certain things. A lot of the language is very similar. The frameworks are similar. And these are the sorts of frameworks you should be using to try to think about tax policy. Not, I want to rinse this guy, they piss me off, this sort of thing. If I have to read another Australian Institute tweet trying to bag people about, resource taxes and the such, and like comparing types of taxes and revenue that aren't comparable, I'm gonna have to delete the app,
Yes.
But yeah, I mean, look, Steve and I have a very common framework. We come from a very similar place. We have slightly different views about things like, high human capital, people's mobility, and how important it is to keep them in Australia and stuff like that. Fine. Like I have no better evidence than Steve does about that.
Also, values too.
Absolutely. But what we don't say is like, that person made a lot of revenue. Why aren't they paying any tax?
So very good. Thanks both for all of this, and sounds like there's a million other topics that you both love to discuss as well. So
anytime. Thanks for the opportunity.
Okay.
Ciao. Bye.
Bye.
I'm gonna go do my taxes.
Oh, good luck.